I got it.
You got it?
All right.
Well, good afternoon again, folks, and we apologize for all the technical difficulties. That's the first time we've ever had to use a backup deck in our bull sessions here. My name is Ken Kavula, and I started the presentation. Again, I want to introduce our special guest, Kim Butcher from Florida, and Matt Spielman, my good buddy from Houston. And Mark is now with us for as long as his computer lasts. So, Mark, I'm going to go through the Portillo slide again and just indicate that it was a good hot dog, but boy, did it have a lot of stuff on it, okay? And we talked a little bit about the inflation hedge, Costco's inflation hedge at $1.50. Today it would be worth over $4 if inflation were allowed to run rampant during those, golly, what is that, over 30 years, almost 40 years now, isn't it?
An American institution.
Yeah, right. I also mentioned, Mark, the Sam's rotisserie chicken at $4.99, which has been around for as long as I can remember. And they've indicated that price is not going to go anywhere either. So, Matt, why don't you tell us all again about this gentleman with the red headband here?
Sure. First, I just want to check because I did not hear recording starting, and I'm still showing the button going. I'm not sure that we actually went off, but I can recap it quick.
I'm okay on my end.
Okay.
Yeah, and we have at the bottom of the control panel, it tells us it's being recorded, Matt.
That is Roaring Kitty. Oh, I do see that now too. Thanks, Ken. That is Roaring Kitty, aka Keith Gill, in the physical world. One of the forces behind the former GameStop move and this specific one shown right here, as he just closed. I think it was it's a $260 million stake in the company. He did a screenshot of his holdings. He's made the news. The Wall Street Journal reports, and this is not published, this is from insiders or people familiar with it. His broker is E-Trade, which is now owned by Morgan Stanley. Is our favored discount brokers sort of blend into other ones. Was considering dropping him, as they're concerned that his publicity, given the size of his holdings, may attract regulatory attention for them.
Yeah, it's a tangled web. It'll be interesting to see the explanation of how he managed to go from 20 million to basically 300 million. He was up, by the way, 260 million at one point in one day yesterday. Just an amazing phenomenon. It'll be interesting to see the explanation. They believe that it's been built principally on options trading.
I read an article also that said that it was on options.
Probably put out by an options house. I don't know.
All the more worrying that he's publicizing his stake.
Yeah, interesting stuff. It'll be interesting to see how it comes down. Anybody who has criticized it has come under artillery fire from Reddit and all the social media sites. So we'll refrain from doing that. All right. Sorry for we have to catch up, but we'll appreciate your flexibility, audience. You guys all know this drill. This is our standard disclaimer. No recommendation is intended. Our sole purpose here today is share some ideas, and there's a bunch of them coming at you here in the next few minutes. Please do your own homework, and if we own some of the things we talk about, we'll try to remember to disclose that. But have some fun, take the ideas, study them, act where it makes sense to do so. If you want copies of the slides, or if you have follow-up questions, our two email addresses are there at the bottom. All right, here's our traditional slide, which basically places the average return forecast somewhere in the 9 to 10% range. Just to give a frame of reference, it had dropped down from 10.7 at value line to now 9.7 this week. And you can see that they're beginning to run together pretty closely. And somebody asked me the question, called me on the phone, asked me the question, did I not think that stocks were now insanely overvalued And I actually used this slide to say, no, I don't. I think they're pretty much fairly valued, perhaps even slightly undervalued, despite what they're saying on the nightly news. So anytime that green bar on the right is below that blue line, we basically are comfortable and believe that there are opportunities to be discovered. Any thoughts there, Ken?
No, I accept to say, Mark, that when you hear on the talking heads, they talk about the market. I think they're really talking about 20 or 30 stocks, and it's not necessarily the Dow 30 that they're talking about. And that leaves a few thousand other stocks that might not be following the pattern of some of these ones that get talked about ad nauseum on any particular program you turn on. So I think you have to be really careful when you're listening to somebody on television characterize what the entire market is doing at a particular time. Value Line is characterizing what, about 1,700 stocks, and Manifest is characterizing, I don't know, what's the size of the database today, Mark? Do you know?
It's about 2,700.
Okay, so we're characterizing a lot more than just the most popular 25 or 30 that are being discussed all the time.
All right, go ahead and give us the next one.
Okay, there we go.
Oh, our Groundhog update. And I think you'll have to wipe away those circles if you want to on the right. But the Groundhog update is, they seem to be persistent. There you go. Here's the top 42. And, oh, by the way, Jim Gallagher was in 114th place 2 weeks ago, 31st last week, and he's now in first. And he has an absolute launchpad stock. He is from that area of the country, somewhere in the north half of Florida, and a member of the Space Coast contingent down there, one of our winning clubs, and some pretty good. Ken is doing some math for me. 12 out of 42. Oh, he's saying that he was.
No, I'm saying that there's 12 clubs on this list of the top 42.
There you go.
I
thought you were drawing attention to the fact that you were in 12th place last week.
No, I'm in 10th place now. Why talk about 12th when I'm in 10th, Mark? All right.
Yeah, that's a pretty good number of clubs in that top group. And a threat to win it. Broad assets, Four Corners, Bower City Ladies, always. And a number of pretty persistent clubs. The Cool Kids dropped down a little bit, but they're up at the top too. So again, the market since Groundhog Day has been up 5 or 6%, depending on what you look at. 7% by that broader Wilshire 5000, and it's a pretty good collection of companies compared to those numbers, or participants, I should say. Groundhog participants. Kathy is still 171st, and we are deeply troubled that the monkey has climbed up to 45th. We live in fear that the monkey might actually take home a trophy one day. All right. Anything else here, Ken?
No, we're questionless at the present time.
Okay.
So let's see if I can advance this slide again. There we go. All right.
All right, here's our performance perspectives. You guys are pretty familiar with our long-term look at a number of companies. This is actually a response to a couple of emails. An investor wrote and asked the questions. Well, you talk about those top 7 all-time favorites or most widely followed companies. What about 8, 9, and 10? Well, there's 8, 9, and 10. Home Depot, Stryker, and CVS Health. Home Depot and Stryker are performing well with the other 7. And CVS, I think that captures in a pretty good nutshell a frustration that many of us have had in a large plate of patients with CVS Health, and it's not cooperated very well over the last 10 years. And it'll be interesting to see. Silence just picked CVS Health for the most recent roundtable, and he believes that the company transformation is still promising work in progress. So we'll see if that will actually come out of their lackluster dry spell. And good, clean fun. The other answer was how would the Dow Jones Industrials, that group of 30 stocks, compare? And you can see it checks in right there with the Wilshire 5000. The reason that the 7.4 is different is it includes the lost decade, which greatly impacted the Dow Jones Industrial Average. So you basically had a decade of zero, and it definitely shows up here, but it compares very favorably to the Wilshire 5000 over these longer periods of time. We're going to talk about Cognizant. Just want you to kind of freeze in your mind that long-term performance at number one, 24.4%, beating the market by approximately 16% over the last 25 years. And that's an oh my, for sure. Any favorites on here, Ken?
Well, you know that I own I used to own all of the top 7. I only own 6 of the top 7 now, but I think they're really in good shape. I don't know what to say about stocks like these particular group of 10 stocks. And to be honest, if those 10 were my portfolio and the only one that was misperforming was CVS, and it still was giving me 12% a year, I'm sorry, still giving me a positive return, 0% positive, I wouldn't be that concerned about it. Maybe concerned enough to move it out eventually, but if I could have positive returns on every one of the stocks for the period of time that we're looking at here, I mean, we're looking at a minimum of 20 years or longer for most of these.
Yeah, for those top holdings, and definitely Home Depot, we'll be talking about here in a few minutes. We also do like to point out, especially if you're new to us, if you are, welcome. Those 2 demonstrations, the one at the bottom is the one I think is most significant, the Investing Roundtable. That's our monthly webcast where we get together and just share ideas. And it's basically beating the market by about 5% over nearly 15 years now. Well, coming up on 14 years, so we'll be starting our 15th year, but it's just a phenomenal demonstration of how we bring ideas and take care of a portfolio and show that this can be done by virtually anybody who wants to put their mind to it. Good stuff. All right, let's keep rolling because we've got a lot of stuff to look at here today. This is a quick one. This is just for those of you who track these 4 sources of ideas. These are the top performing institutional, mutual, and exchange traded funds over the last 10 years with a couple of exceptions. The column on the far right is the answer to the question, how much did they beat the market by? And you can see, as Ken has pointed out, it's 12 or 13 have actually beaten the market by that magic 5% that we're shooting for and achieving with the round table. This is out of a population of over 600 funds. So that gives you an idea of how special it is to be able to do that. The other thing that we love to use this chart for, to point out, is what basically works. And we think you want double-digit growth in your overall portfolio in combination with excellent quality and decent return forecasts. But the real key for us, and that's what we're going to talk about, this notion of being assertive. You can't do this without having the right blend of smaller, faster growing, promising companies, the medium-sized companies, and a dose or a splash of the solid performing blue chips. So we think it's a recipe for success. We also think that this type of a list is a source of ideas if you dive into their holdings and see what they're buying lately. Your thoughts, Ken?
Well, also, if you're in the audience and you're thinking to yourself, I really would like to buy some ETFs or some mutual funds. I much prefer ETFs now that they exist, and there's lots of them. But if you're thinking you might want to buy some, here's a good list of 12 to start taking a look at. Maybe it's a good list of 20 to start taking a look at, because I wouldn't be sneezing at any of the returns on any of these over long periods of time.
Yeah, and I think that the Motley Fool 100 is a great source of ideas, if not direct investing. And VGT has been extremely rewarding to anybody that's been at it. My dad had that for over 20 years. So he basically rode that wave with his retirement account, and that's why we publish this list. So just stay tuned to it. The Bridgeway Blue Chip is another place that I would just kind of watch what they buy. They've only been around for a couple of years, but they've got a 29% annualized rate of return in their short history. All right, let's keep trudging along. So we think that works. All right, we're just going to have just noticing some things here. Matt's favorite subject is housing and the future of the housing market in the United States. And Mr. Rosenberg is, I respect him. I think he's one of the best economists in the country. It's just pointing out that that's a fairly uncomfortable graph. Matt, what was your reaction?
Well, I think it is, and I think in both cases we're trying to figure out his punchline in the tweet, right? So the idea that the Fed has slowed things down because the housing market is one of the most sensitive sectors. What might moderate this for me is you have to understand when they talk about pending home sales, this comes from the National Association of Realtors. That by and large, that counts transactions in the MLS system. So that by and large does not include new home sales. And it's been true really since 2021. The new home sales have been overrepresented in if you call it normal, just say pre-pandemic. New home sales are about 15% of the market. They've been 25 to 30 now for the third year straight. So this is definitely an indicator that the Fed is slowing things down, and that should necessarily come to a stop once their mission is accomplished. But it's also a point that existing home sales at this point are competition for new home sales. So if the competition is having a hard day, it's a good day for you.
Matt, I have a question. Is there any research that you've come across that indicates how much a cash offer for a house, an all cash offer for the entire thing, how many of those transactions are off of the MLS books completely?
No, I'll say it's been quite common in my own neighborhood, and as dangerous as looking at anecdotes are. The slowdown in my neighborhood is that a house actually gets a sign in the yard and might be there for a week or two, as opposed to you just see moving trucks. But I don't know of any kind of off-market or off-MLS measurement. But it's a good point. Since the pandemic, as real estate transactions have been feverish, it's probably a bigger proportion than what it had been pre-pandemic as well.
The reason that I asked the question, Matt, was that the only people that I'm really seeing eager to move now are people that can take a huge amount of money out of their current house and turn around and put it right back into the house they're going to move into, and therefore avoid the banks altogether. And I'm just wondering if that makes it if that makes for a little bit of a reason why you might not want to involve a real estate broker in the whole deal.
Yeah, well, and the other point too, the real estate industry has been subject to settlements, including by NAR, about brokerage commissions. So it certainly is not a steady state. Whatever happened before, are commissions going down? Are people doing some kind of alternate arrangement that doesn't use commissions? I think that's an unknown as well.
Okay, I just wondered if you had read any research about anything like that. Okay.
We were hearing from real estate agents in our area that they have never seen the type of conditional offers that have been happening around here frequently. There's a very small inventory of homes and there's some demand. So people are walking in and saying, I will match whatever offer comes in, add 15%. And by the way, I'll be writing you a check for that. And they've not seen anything like that in the past. And it's a reality. So it's also
reality when I'm sitting in Florida and I'm getting more than once phone calls from realtors saying, is this your house? Are you willing to sell it?
Wow.
I'm like, no, take me off the list.
Well, I used to say no all the time, and then I thought, well, maybe I should hear the number, because there's obviously a number that would work, right? You know?
Yeah, well, I'm still shocked because of what I paid for it, and maybe it's worth 3 times as much or 4. And I'm like,
Yeah.
what? It's overpriced.
Wild stuff. And that takes us to the number on the right. That's the Chicago Purchasing Managers Index. And I think Rosie's just basically making the point that generally portends a real recession. And we've been sitting around here for the last 2 or 3 years talking about the recession. Seems to me like the recession conversations have kind of disappeared. And I think, you guys correct me if I'm wrong here, my interpretation was that you said the recession hit after you guys stopped worrying about it in those 3 previous instances. And he's basically saying that we have gotten to the point where maybe it's time to actually be worried for real. Again, recessions don't kill us. What we know happens with the recession is you get all of your stock studies get kind of thrown into the disarray, take a hit on the profitability for many companies, and but you basically live to fight on, unless you're very close to your life expectancy, and then that's a different condition. Maybe you do protect yourself a little bit more, but for the average person, even the senior people, the very experienced people in this audience, that advice is probably not anything terribly meaningful other than build up some cash and get ready to go shopping. What are your thoughts, Ken?
Well, I think that if you keep talking about a recession, you're bound to have one. But if you keep not talking about a recession, you're bound to have one as well. I just don't think anything constructive comes out of worrying about what might happen 12 months from now, or 6 months from now, or 3 weeks from now. I'm not quite sure what the strategy would be if you knew that one was coming on December 1st. What would the strategy be? Would you suddenly throw the economy into a tizzy and sell everything you own and turn it all into cash, or would you be buying other things? Would you be rejiggering your portfolio? What do you do now that you know the recession might be coming? I still think that investing regularly and looking for good companies at good prices over the long run is going to serve me well. And because I'm confident of that, I'm not going to take any drastic steps to try to avoid some bad tasting news that might come through in the next 3 months, 6 months, 12 months, 18 months. I don't know when. But I didn't know when before you started talking about it either.
Very true, but much of the financial services industry spends a lot of time on the topic, and we just like to. I think your answer is perfect. Somebody sent me a note quoting Warren Buffett earlier today that when they buy a stock and the price goes down, they smile and buy more. If the price goes up, they are less enthusiastic. So prices going down are just a reason to find another shopping gear, I guess, when you can. All right. And speaking of shopping gears, this is basically making the cases from Ben Carlson, one of the Ritholtz gang, and just basically making the point that it looks to me like there is a fair amount of cash in reserve waiting to buy some stocks. So maybe that cushions the fall and enables some prudent shopping in the future for those market timers and traders out there. Good stuff. All right, I think we beat this subject to death, so let's go ahead and move on. Here's another fun slide. Not quite sure what to think of it other than to point out that I wonder why those circles persist on your pages. It's kind of weird stuff.
I don't know. There we go.
All right, this is from another guy that inhabits the Twitter sphere. His name is JC Peretz, and he runs All Star Charts. And this is a group of stocks that have shown an inordinate high level of investor interest. Now, we don't know how he measures that. It's some form of sentiment indicator, but just found it to be a fairly interesting list of stocks. I certainly want to look over some of the stocks that are less well known. We were talking before the session that Ken doesn't own any of these, so Ken, get to work.
I
see what
don't
is
own
going on here.
not a single one of these 60 stocks, Mark. Okay.
You have talked about Elf Beauty though in the past.
I've talked about it. We brought this one to a stock panel at Bink. I have owned Eagle Materials at various times. Most recently, about a year and a half ago, but it took off and went up with a whole bunch of other housing related stocks, and I moved out of it fairly quickly after making what I consider to be a decent profit in it. So
there's some interesting
that's the only one that I've even owned in the near past.
You talk about Lulu a lot, and Lulu's been in the works, and it certainly has been getting more attractive if you believe that the company's got a future, and that one is there. Talked about by Stephanie and Josh quite a bit. Toll Brothers on there. Williams-Sonoma is one of the better selections we've made in recent years for the roundtable. That was one of the best stock studies done in the history of stock studies at the time. Yeah, there's just some good companies on there. That Cushman and Wakefield PLC. I don't know if that's a publicly traded company, but I didn't get a chance to look at it yet. But there's some interesting companies there. All right.
Yeah, I've owned First Solar before. It would have several outlier years you'd have to forgive, but one of the strongest players in solar, and focused on industrial solar rather than just rooftop residential. So not as commoditized as you might think.
And I do think there's been some conversation in our forum on global foundries in the past, and that could be worth a closer look.
Isn't this a competitor of Taiwan Semi, Mark?
I think it is. Matt, do you know for sure?
Yeah.
Yep.
By and large.
Good stuff. All right, just a source of ideas. And I think it could be, if you do find one of these that looks really, really attractive to you, send us an email.
And if you find any on the list that you'd like to have covered in Manifest, an email to Mark at manifestinvesting.com will give us the opportunity to try to cover it. Sometimes it's very difficult to cover a stock without any earnings, but Mark makes a good stab at it anyway. So
yeah, I did blow away a couple companies that were pre-revenues that were in the database. I just got tired of guessing.
We got a couple comments from the audience. Kevin Glogly says his club owns Cavco, number 45.
Sure.
Bonnie Dumas, I'm not sure, Bonnie, if you own it, so you're interested in South State? I don't have a number for that.
That's number 50, South State Corporation. It's a bank.
Yeah.
Pretty sure it's a bank. Bonnie can correct me. The other one that we were talking about before the session got started, Zoom Video Communications, is on that list, and that's come down huge from its peak during COVID, during the pandemic, but that's still a pretty formidable company, and it might be worth scratching one's head over.
Is it a coincidence that GameStop and Zoom are coming back at the same time?
It could be.
I will give a little bit of a commercial for Zoom, Mark. They've moved into a product that has a lot of similarities to the Microsoft Team product.
Mm-hmm.
And that's drawing a lot of interest because it's so much less expensive than the Microsoft product. And it's probably not aimed at professional teams, commercial teams. It's probably more aimed at people doing committee work and things like that want to gather as a team and be able to share documents real quickly. But I have played a little bit with that tool, and it's really kind of interesting to take a look at it. And a lot of it you can get for virtually nothing.
Yeah, a lot of potential studies here. Let us know if you see anything really cool. All right. We're going to spend just a couple of minutes talking about what the Buttonwood Bulls portfolio, it's a demonstration portfolio, is all about. This is the current portfolio as of last evening. You can see that we are building up to that 16-ish level for a total number of positions. We do have room for buying a couple more. We might actually grab one that we talk about here today just for commemorative purposes. But that is the look. Alphabet doing pretty well, and my Vertra is not.
Mark, remind the audience again about how much goes into an average holding at the beginning.
Well, we went with an estimate of what type of money we would have at this point in time, divided it by 16, came up with $162.50 that goes into each position as a starting position. You can see that we just recently took a position in Luminar, and that's simply to play along with the madness. It was a very heavily discussed company at the recent national convention, so we just basically have that as a placeholder. And again, we're playing along with what is clearly not a core company. Unless, Ken, have you declared Laser to be a core stock yet?
Not yet, Mark, no.
Okay, still early. So we're just playing along with that one. Ken will allow some non-core speculative opportunities in the portfolio, and just
well, I would like you to define the word some, because we have 3 at least by my count here. So
are you losing sleep at night?
A little bit. So
okay. All right.
But it's not my cash, it's your cash, so that's okay.
All right, so let's go ahead and talk about the genesis and some of the general guidelines. Next slide.
Come on. There we go.
Okay, here's a quick summary. Again, we wanted it to be a real money portfolio, demonstrating, especially for those of you out there, and there are a few of you in the audience that are kind of following along with your first brokerage account and learning to do the transactions, that sort of thing. And we wanted to demonstrate a real club environment. Even though it's a small demonstration, we wanted to basically demonstrate the concepts, whether it's an individual portfolio or an investment club. So number 2 there, we're going to put 100. That number may change, but for now it's $100 a month going into the portfolio. It's an auto. We actually make an auto transaction, so it comes on the first of every month. Then we want to demonstrate some basic portfolio design and management. So we'll be talking about that. When it comes to buying decisions under 2A, we want to talk about the notion of accumulating existing positions, especially when we get to 16 versus going outside the portfolio. And then last but not least there, number B, we want to show how we think through the selling discipline guidelines, when to sell or trim a particular position. And point number 3, we do want the portfolio to be assertive, not necessarily aggressive, but we want it to have maybe a slightly higher level of double-digit growth as we build it out. We are achieving that right now. So Ken, why don't you go ahead and flip to the portfolio report card and go ahead and give us the.
Well, we're targeting par at somewhere between 15 and around 15%, 14 to 15 to 16%. And right now, the portfolio, as of yesterday, the par was at 13.5. This is a weighted average. I will say that the weighted average does include what will be turned into 3 positions in cash, and that cash comes into the weight at about a 4.5% rate. So that par for just the stocks that we own probably is a little bit higher than that 13.5, and that's okay. Nothing wrong with that. We're trying to keep quality at 80 or above. We're trying to keep growth, as Mark indicated, assertive. We don't want to get wild and crazy, but we do want to be assertive. We had been talking about growth of 11.5, 12.5, 13% as being enough to achieve the targets of around 15% or beating the market by 5 points. Mark and I are coming to the conclusion that growth needs to be a little bit stronger than the 12.5, 13% we had been talking about, and perhaps a better target would be 14%, somewhere in that range. And again, we're talking about growth in sales. We're not looking at earnings growth. We're looking at sales sales growth. Everything comes from sales. We want the PE to stay reasonable, and if it's an aggressive, assertive portfolio, a PE in the realm of mid to high 20s, I don't think is unreasonable. So this PE ratio, again, it's a weighted average at 28, and I think that it's okay. If I were looking at that right now and seeing a 45, I'd be very concerned. If I were seeing a 35, I might be very concerned. And likewise, if I were seeing a 15 or a 14, something in those lines, I probably would be concerned that we were not going to be able to meet our goals. With a PE ratio in the mid to high 20s, I think we have a good shot of meeting the goals. Yield is icing on the cake. It's the cherry on top of the sundae. It's nice, but it's not necessary. So a 1.3% yield, while it's not close to what the market is averaging right now, we think a good solid yield for a dividend stock should be at least 2% or more. But 1.3, we'll take it and we'll reinvest it directly back into the portfolio, not necessarily into the stock that gave us the dividend, but the money will be retained and go back into the entire portfolio. We'd like to keep financial strength and earnings stability at around 80 or above. They're a little bit light right now, but as we indicated, we have 3 non-core stocks on there right now, which probably have lower financial strength, lower EPS stability. Excuse me. And as we round out the portfolio, we have 3 more holdings to add. We're going to be looking at our core, non-core balance, and we're going to want to make sure that our core represents somewhere between 3/4 and 80% of the entire portfolio. This is the goal. We've had so many questions about the round table portfolio and how do you really run a portfolio that a club could emulate. The round table portfolio is a tracking portfolio for a bunch of choices over an extremely long period of time. A club's portfolio, in my opinion at least, is 16 plus or minus 4 stocks, maybe fewer if the club is smaller, maybe a tad more if the club is larger, and they keep those stock numbers, the total number of stocks in the portfolio, they maintain the discipline so that they can adequately follow each and every one of those stocks and know when it's appropriate to add more to one of the holdings and when it might be appropriate to trim or to completely eliminate a stock from the portfolio. Mark, that was a long explanation, but I think it goes to the heart of what Buttonwood is all about.
I think you're absolutely right. Let's press on. So we don't obsess over sector diversification, but we certainly would like to see it distributed well. If I had any one guideline from looking at this chart, I would say the next stock that we add, we might want to avoid discretionary a little bit. We might want to steer towards technology. You can still see that we still have 18% cash. So we've got a little bit more of pie distribution to be done. And as far as the size diversification, I think we're fine. Again, our emphasis for the outlook for the overall sales really does kind of trump the pie chart, but we do want to see a blend of companies, small, medium, and large. And it's in pretty good shape at this point. Wouldn't be such a bad idea to find a large technology company, Ken, that might fit your appetite.
I'm thinking that exact same thing, Mark, and I got 4 or 5 at the top of my mind right now. I'm not sure any of them are affordable right now, but I'm thinking.
Okay, we might have to wait for it, in other words. We'll see. All right, I think we're good on this then. Hopefully that helps everybody understand a little bit more about it. Okay, here's just a quick look at Value Line actually runs a feature on YouTube. It's called One Stock to Buy. They come out with a monthly presentation, and you can actually go back and look at them. We're actually keeping track of their selections over time, And they're just demonstrating that this can be a frustrating business a little bit. I do think that when I take a step back, close one eye, and squint a little bit, I do find myself drawn to the companies that have the higher growth rates, the higher quality, and the higher return forecasts that seem to be a little more green than the others. And they seem to be doing a little bit better here lately, so maybe things are looking up. But there's a couple stinkers in there that are not helping them very much. And it can be a very humbling thing to do this thing in public, so we will see. In general, they're pretty good presentations, and you can pick up some value line features monitoring them. Their most recent selection was Axon. That would be a direct competitor to our Vertra holding in the Buttonwood portfolio, but it's an interesting company. You probably know them as Don't Tase Me Bro, the taser company. And that's the company that is now Axon Enterprises, and the most recent presentation.
And to be really fair to Axon, these numbers over here are based on an extremely short amount of history here. So in fact, maybe for the first 3 months here, I would I know they're red, but they're also based on extremely small amounts of data. So don't sell the barn yet.
No, they need time to bake. All right, so if you go to the next page, you get a quicker look at Axon. It is a company that has been in a transformation, decent size acquisition a couple years ago, and actually looking pretty good when it comes to the sales forecast. Pretty much up straight and parallel. Very high quality company right now. I would not characterize it as a screaming buy, but time will tell. All right, let's have some fun with Ken. Every once in a while, Ken tells me about his latest infatuation, and now it's Stephanie. I don't know if she edges out Maria Bartiromo or not, but Maria's kind of in the Hall of Fame.
Well,
I do enjoy listening to Stephanie. Your thoughts, Ken?
Well, Maria might have jumped off the cliff. I'm not sure what Maria's doing anymore, but I watch CNBC for entertainment an awful lot. It's on in the background when I do a lot of computer work. I found after working in a school environment for as many years as I did that I needed a little bit of noise when I was writing curriculum, and this provides the noise in the background as I sit and write classroom curriculum and that kind of stuff. And I've been drawn to the kinds of things that this particular analyst has to say. Here's her a short biography over on the right-hand side. She holds a pretty high-powered job right now.
She sure does.
Chief investment strategist for Hightower. Hightower is one of the most respected financial planning institutions in the country, wealth management institutions. It's probably not as well known as maybe Blackstone or some of those, but it's extremely respected, and she has quite a pedigree. You can see that she's worked for everyone from Jim Cramer to the folks at in some of the big banks, and before that did a lot of work on the street, which was not which was the name of a website, by the way. She did. I won't even go there. Okay.
Interesting choice of words there, Ken.
Anyway, I think that she really says a lot of things that I tend to agree with. She's been talking for the last year about barbells in her portfolio, and when she first started talking about barbells, I was kind of dumbstruck. I had no idea what she meant by that. But I think what she's talking about when she mentions barbells, and I'm seeing it in some of the portfolios that she's running, she means that she has two main groups, and they kind of seem to be diametrically opposed to each other. I'm doing okay in the Groundhog contest right now, and I tried to put together a barbell portfolio. I have two really big tech stocks in that portfolio and four really small stocks that I would not own all four at the same time in my personal portfolio, but for a contest, they seem to make sense. That to me was a barbell with these 4 very small and these 2 very large, and it's performing quite well right now, at least in the Groundhog. She is doing barbell stuff with a lot of mutual funds at one end of the barbell, and a lot of dare I say, bluest of the blue chips at the other end of the barbell, and seems to be beating the market, albeit not by the 5 points we'd like to see, but seems to be able to at least match the market, and in some cases do better than that. Maybe we should go to her portfolio, Mark, and take a look at it, right?
Yeah, I just have one quick story. I mean, she was appearing
Okay.
on Josh Brown's The Compound podcast, and on the lower left there was actually a link where you can go, or just go to YouTube and search on her name. This podcast will come up. We'll show you in a second the content of that. But early on in the podcast, you can see at 12:45 she talks about Jim Cramer, and she worked directly for him. She tells a very endearing story about how she came to work for him and how Jim, I think, rather dramatically supported her efforts to find a good work balance with her brand new infant daughter at the time. And just a really nice story about how she was brought along at the street and with Jim Cramer. So a very nice Jim Cramer story. I think sometimes there's too many bad Jim Cramer stories out there. It was good to hear a nice one. The agenda that they cover in that YouTube presentation at the compound is shown there on the left, and they covered Apple, Nvidia, and then a few other stocks. The ones that are on the right there were mentioned specifically by her as being on her either in ownership or on a fairly short shopping list. So I think that list is fairly indicative that she thinks, at least in a way, very similar to us. You heard Ken mention the blue chip. She certainly has that, and there's a number of selections there that have been recently made either at roundtables or in some of our other portfolios of late. So good, clean fun. And then later on in the podcast, go back one slide, Ken. You can see there was a section where they talked about housing. We were just talking about that with the Rosie slide. I felt like I was listening to some type of a blend of Matt Spielman and Ken Kavula, talking about the housing and the pent-up demand and the lack of supply and all that kind of stuff. And you'll see that she did mention specifically D.R. Horton, but then she also mentioned specifically the Home Depot and those type of companies for renovations and what they are basically tracking fairly carefully. And Tractor Supply fell into this also. People are basically renovating their existing housing and not making the jump from one to another. And it's a fairly large situation right now. A lot of talk about the cybersecurity also that was pretty good to listen through. Any thoughts on these companies, Ken? What strikes you?
I like this list a lot, Mark. I think there's good solid buys. There's up, straight, and parallels. There's a great diversity of sectors on this list, and you know, not every company on this list is for everybody. But I will say that I think you could go down this list and find a stock that you might be interested in putting some money into. And it's not that long a list. What is it, a dozen, maybe 10 companies? So
yeah, and you're going to see they've got a pretty long list here as we switch. But hey, on Apple, it was kind of funny because she's sitting there with Josh Brown, and she and Josh serve on a couple of the shows that are regular staples at CNBC. Ken feels like he's on a first name basis with both of them. And the host of one of the shows was basically challenging the panel to talk about Apple, and he finally just threw up his hand and says, come on, every single one of you owns Apple in your portfolios or your clients, you know, tell me what you really think. And it was kind of funny, but her current position, and I think Josh shared it, and he does so in that YouTube video, is that the China thing is actually working out better than anybody would have expected, but from a different angle. Apparently, the actual operating results from the iPhones were much stronger than expected in China in the most recent quarter. So Apple overall is doing pretty well, but you take out that really nice news from China, and it's a pretty interesting picture. And then Hugh McManus came to mind as she talked about how so many people are loathing and are fearful about the company, and that's how it's been kind of beaten down a little bit. And they think some of that's a little bit overdone. The settlement for what they charge in their Apple store is something that is frequently thrown onto the front burner, but that's not going to be resolved overnight, and it'll probably be resolved, in their opinion, more amicably than most people believe. So it still remains a pretty formidable company, and they both basically concurred that, including Michael Batnick, that it's probably underestimated right now. So kind of a different perspective than what we are hearing from many of the rhinos out there. Just thought it was kind of interesting. Next slide.
I am having trouble making it advance. There we go.
Okay. I don't know. Our technology seems to be not cooperating very well. This is just a quick look at one of the core portfolios at Hightower for their institutional accounts, and it's tracked by Insider Monkey. You can actually go to insidermonkey.com with a free account. You just register. You could actually go in and check out any Hightower thing. And Ken is making an editorial correction here because he couldn't resist pointing out that that's the B shares of Berkshire Hathaway. But this is their top 40 holdings. I put number 41 on there because that was the first one that really kind of triggered me. But you can see these are a lot of household names. I don't think we're going to discover anything earth-shattering here. Kind of interesting to see number 35, Pioneer Natural Resources, up as high as it is. Might scratch our heads over that a little bit. But this is the type of portfolio, this is my opinion, it's going to pretty well match the market because of the virtual size of it. You can see that the average position size on here is less than 1%. So it's got a whole bunch of holdings in it, and many of the holdings are actually large groups of stocks, like the QQQs there at number 14. So this is just basically a collection of a lot of very familiar names. But number 41 is one that I had heard of. I've seen the equipment. We're going to talk about that one. SharkNinja, which Matt believes to be some type of a B-rate, what is it, a B movie?
Yeah, prequel to Sharknado, probably.
Okay. All right, so go ahead and take us to the next one, Ken. SharkNinja. I was not familiar with the company, so I grabbed it for a closer look. This is a pretty well-established company. You're talking about $4.5 billion in sales, and I had seen the vacuum cleaner, and I had heard some of the stories that vacuum cleaner actually was quite disruptive and innovative, and caused some other vacuum cleaners to kind of, dare I say, clean up their act. I can't believe I just did that, but you can see this is, the projections for the next 3 years are strong, and the earnings are strong, profitability pretty good. It's not necessarily a screaming buy right now. It's not necessarily a high quality company yet, but that's because of the limited track record. But I think many of you in the audience are probably pretty familiar with some of those consumer products, and these guys aren't messing around. What are your thoughts? What's your experience been with SharkNinja, Ken?
I when it first came on the market, Mark, I kind of regarded it as things that you buy that you see on infomercials on TV, and didn't pay it much attention at all. But as I started to need various things to replace household appliances, vacuum cleaner especially, smaller appliances, toaster oven, things like that, we started looking at Consumer Reports and found that the SharkNinja products were being consistently rated at the top end of the market, no matter what the product was. They were beating out established brand names like Hoover and Bissell and things like that. And that led me to actually purchase a SharkNinja for the carpet cleaning, and we're quite happy with it, quite pleased with it. So that's my only experience with it. I no longer think of it as a infomercial brand. I think of it as a brand of pretty high quality goods, and I base that on the fact that one of my most trusted journals, Consumer Reports, seems to believe that their products are at the high end of almost any of the categories that they enter.
Yeah, my only awareness is that they've been considered to be innovative and disruptive, and that apparently their products are priced fairly attractively. And it's certainly worth following a little bit closer. I would like to see the price a little bit lower. If I do buy one of these and I get a set of steak knives, I think I'll retire our existing steak knives and send my old steak knives to Kevin Gologly.
No, that's not Ninja. That's Ginzu, Mark.
Oh, that's Ginzu. Okay, I guess Kevin, don't count on those steak knives coming anytime soon. All right, that's all I got on that one. Other than I'd be interested to see how that stacks up versus our Roomba or Zumba or whatever that thing is that runs around our house. All right, and digging into this company that Stephanie works for, it was founded by a guy named Thomas Lee, but a different Thomas Lee. But it also brought up the reminder about this Thomas Lee. He's actually from Funstrat, and he's a regular guest. He's on Twitter. A lot of fun on CNBC. I know Ken has definitely mentioned him in the past. We featured him back around Halloween last year, week before Halloween, and his 5 picks are doing pretty well. And he's got a pretty good track record. And then I looked up his fairly recent listing of what he calls his Grannie shots, and that's related to the way that Rick Barry, boy, I'm really dating myself now, used to shoot his free throws in the NBA, underhanded. That's what the Grannie shots are, because you can actually do it different and be very effective. That's why they call these Grannie shots. We'll probably talk about them a little bit more, but as you go down that list, there's a couple new names on there for me, and I think probably for many in the audience. There's Lens Texas Pacific, but Installed Building Products has been very good to our tracking portfolios in the round table. NAPCO is our current top selection in the best small companies. Palantir has made some noise. You can basically just get a feel for the type of companies. This is just simply a list of when these particular companies were going to report earnings a few weeks ago. And the X's are just before the opening bell or after the closing bell on those particular days. But boy, you're looking for a list of companies perhaps to study. I find Tom to be very reliable and engaging and worth listening to. Any other thoughts, Ken?
No, I'm trying to get the slides to go here. So there we go. Look at that. All right.
All right. We thought we would close today with just a quick look at the consulting space. And we've been talking about this for a while. And I believe, Ken, you've got a model club challenge of Cognizant coming up in what, a couple weeks?
About 2 weeks. We're challenging Cognizant. The longtime stock watcher for Cognizant, about 6 or 8 weeks ago, she decided that she wasn't as pleased with the forward potential of the stock as she had been, and she asked us to put together an industry study and include Cognizant in the group, and then see if we still think it's the best or one of the best in the industry. We're going to challenge it with get the right list out here. We're going to challenge it with Accenture, Infosys, Genpact, and EXLService, which are 4 either direct competitors or overlapping peers, overlapping competitors to Cognizant. And I'll tell you the results when we're all finished. In about maybe a month, we'll have the results ready to go. And I'll let you know whether we sold our Cognizant from the club. We've owned it for maybe 15 years, whether we've sold it or sold part of it, or what we actually did after we listened to the industry study.
Yeah, and this particular slide was inspired by sitting around the the proverbial pub table at the national convention a couple weeks ago, listening to people talk about maybe you want to be a little bit careful as you look at all of these companies. McKinsey, we've had this up here for a couple weeks now. McKinsey is a private company, but they are talking about weathering a storm and laying a few people off. But I thought that this graphic captures fairly well what seems to be happening. At least it captures the flat spot between 22 and 23 and a relative inflection in the field of opportunity. What I did here was I took about 50 of the largest consulting and IT services firms and just basically added up all of their historical results along with their projections to come up with this chart. It definitely shows something to be aware of as you're thinking about investing in this industry. So it's a pretty good inflection point, and maybe it is temporary, but it certainly would encourage anybody doing a study in this realm to perhaps temper their top line growth expectations a little bit. So Ken, let's go ahead and take a look at the situation here with Cognizant. This is one of those situations where we kind of hate to be right. What you're looking at is the value line sheet from Cognizant up there at the top, and you can see the flat spot. And basically around 2019, we actually ran a show called Cognizant Nation and questioned whether or not this company was starting to run out of steam a little bit. They had a change in management. The industry conditions certainly came at a pretty bad time for the new CEO, but they've been pretty sluggish over the last several years. Just kind of wondering, maybe there might be better opportunities out there elsewhere. I think it's definitely a worthwhile challenge in a club environment. And go ahead, Ken. I'll make sure that the forum includes the reference to that Cognizant Nation podcast from June 2019. So all I did here was grab some of the top companies in these 4 related industries. And I do find it kind of interesting that notice that the projected annual returns, the return forecasts in the consulting industry are the lowest on this page. And of course, there's a lot of overlap here. The IT services is kind of closer to what we're talking about with Cognizant. That's the one on the left. But you also have software application, a lot of overlap between some of those firms and the firms on the left. And then some of the E&C, engineering and construction firms, sneak in here also. But here was the short list of companies. We included Accenture on the list because they are the $64 billion gorilla in this industry. And you can see from top to bottom, there's some fairly compelling statistics. And I would probably go hunting among NICE, which we recently added to the roundtable, Genpact, EXLS. If you're frisky, that one down at the bottom is Double Verify, company brought to the National Convention and our recent panel by Susie Artsberger, who operates in this industry on behalf of Better Investing every day. So there's some interesting stats on here, some low relative strength indices right down the middle of the page there, and some decent return forecasts. So Ken, I think the company you choose is probably going to come from there.
I agree. The only company that we're looking at that's not on this short list here is Infosys, Mark. And Infosys has been a traditional direct competitor to Cognizant, and it seems to be doing much better with projection in sales and earnings right now. So that's why it made the study for us.
I do think India is a kind of an amazing powerhouse right now, and I believe Infosys has quite a bit of its corporate assets right there in India.
Absolutely, it does. Yeah.
So it's a good play on current situation. So we'll be interested to see how you guys end up after raking this industry over the coals.
I will be sure to report. It won't be next week or the week after, but when we get it done, I'll make sure that I bring something back and share it with everybody.
All right. Any other thoughts or comments?
No, I'm trying to get there. We go. Look at that. Okay.
Well, there you go. There's a look at our 8 most recent sessions. We do archive all of the bull sessions and roundtables and some of our educational sessions on YouTube under Manifest Investing. That Motley crew on the upper left was part of that consulting discussion. At least one of those individuals works directly for Accenture, so we got a kind of a feel for the situation out there, and some good fun all along the way. And I think we've got just a couple more. What did I put in here? I thought I put the Berkshire slide in here. I didn't. Okay, I added that later.
Nope. You might have put it in your deck, but this is the deck you sent to me. So yeah.
All right. Well, the guy on the left on that one was we get every time one of you guys goes to either Buc-ee's or Portillo's, you send us a picture. That happens to be Roy Chastain at Buc-ee's, and his one-word description of the experience was, "Wow." And Buc-ee's is definitely a phenomenon. And then the most recent roundtable, I was simply celebrating the fact that I came in close enough to be considered a tie for first with Nice versus Monster. I only get to do that a couple times a year, so I thought I would celebrate a little bit there, Ken.
Okay. All right. I will announce, Mark, that at the exit off of I-40 that goes right into the Great Smoky Mountains National Park through Sevierville and Pigeon Forge, and a lot of folks in the audience will know exactly where I'm talking about. There is a new Buc-ee's, and Mark, it's bigger than the Buc-ee's that we went to down in Arkansas, if you can believe that.
I can't believe it.
It is huge. It is absolutely enormous. So
it's out there.
Yep.
All right. One announcement, Ken. I'm actually going to be on the road next weekend, or next week for bull sessions. So maybe we take a week off, or would you want to hold one without me?
I think that a week off in the summertime is a nice thing to do, Mark. Okay.
Because we are going to be with our 3 grandsons, basically having a heck of a good time for several days on the road.
I think you should enjoy several days on the road, and I will enjoy a Tuesday. I really enjoy bull sessions, but a Tuesday without a bull session might be a nice thing to have too. So we'll do that. Your
computer probably needs a week off too. It's obviously overworked after drinking.
I have never seen anything like what I just experienced, so that's got me spinning a bit.
Time to get a new one, huh, Mark?
That's a work in progress.
Who get an AI PC?
Any other thoughts, Matt?
No, we're good. There was one other, I think, broader topic that Phil Barr brought up about where to start, which type of account to start. But I've captured that, so maybe that can go into the bullpen for a future session.
Okay. And Kim, any other thoughts from your end?
She dropped off.
She did have to drop off? Yeah, she warned me she might have to do that. Maybe somebody got called and offered to buy her house while she was online.
made that number, so she's ready to go.
There you go. All right. Well, with that, we will. I'll definitely publish that we will not be meeting next week, but that'll just mean we've got twice as much good stuff 2 weeks from now. All right. Thanks, Ken.
Have a great summer, folks. It's just starting, and I'm sitting at the Continental Divide right now, and the Eastern Continental Divide, right on the sign, right next to the sign that says Continental Divide, and we're looking at an absolutely gorgeous day. It was raining to beat the dickens when we started the session, but it's turned into a gorgeous day again. So Natalie and I are going to go out and take a long walk through the woods, I think.
We need pictures.
All right. Good night, everybody.
All right. Take care, everybody. Good luck out there. Let us know if you see anything fascinating and promising. Take care.